focus on Liberia. Hit it! From Cape Mount to Cape Palmer, Mount Nimba to Atlantic Ocean, Obomi Hills to Pocondre, to educate, elevate, and promote. Yeah, focus on Liberia. For Liberia, Liberia. For Liberia, yeah, 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 yeah. From Monday to Sunday. From Monday to Sunday. It's focus on Liberia. Talk about home affairs. Hey. In diaspora. Foreign affairs. Hey. Reliable information. History. Ooh. Talking about culture. Yeah. Politics. Education. Entertainment. Yeah. Business. Sports. Advertisement. Articulation. Focus on Liberia. Focus on Liberia. Focus on Liberia. From Monday to Sunday. Focus on.
Welcome to another session of Focus on Liberia on the Marketplace. I am your host, Gabriel Carter. Today is Saturday, December 27th. And, we've been away for a while, but we're glad to be back to talk about something very important today. This is going to be a series because there's a lot to talk about specifically on this topic. And today we want to talk about maybe spend the next 30 minutes to an hour to talk about sovereign wealth fund. This is something we I think the last show we've had on here, we told you that we're going to come back, but we've spent some time, did some research, so we're now back to shed light on it. Because and the reason why we're even talking about this, because there's been conversation, as we often do, we talk about these things, but anyway, they usually die down. We never really, pursue them. There's been conversation about the possibility of starting a sovereign wealth fund. I think that was a bill put forth. I'm not sure if it was put forth, but it was, written by Representative Tai Wongwe. I'm not sure if that has gained ground within the House of Representatives or within our body of politics. But we wanted to shed a little bit of light on that and really talk about the prospect of, Liberia having its own sovereign wealth fund. And again, the reason why I wanted to talk about this is because this is, part of my work. I've been privileged to deal in that field of sovereign wealth fund, to deal with some investments from sovereign wealth fund, in addition to endowment from some of the best university in the state. From New York to Tennessee, Pennsylvania, you name it, to some of the top university in the country, even some mega churches that you may not even think about. I have some of their, investment in my portfolio. So when I heard about this, I felt this would be a great opportunity to shed light on this discussion. So this is what we're going to do. Whatever you're doing, take some time. I would say maybe, as I said, 30 minutes to an hour. We will talk about this, dive deep into it, and maybe be able to shed some light and answer your questions if I have enough time to do that. So if you will allow me, basically to run through a slide here that I prepared for this. So basically there are, our agenda today will be just going through the question as you see on here. But what a sovereign wealth fund? Uh, what are the objectives, of and types of sovereign wealth funds that are out there? So we're going to look at the top five that are out there. There are top 10s, but as I said, we don't have enough time, so I don't want to look at all 10 of them. So we're just going to do the top five. And also, we're going to look at the investment strategies of not just the sovereign wealth, the top five, but also in general of sovereign wealth funds, what they do. We talk about allocation, portfolio allocation strategies, how you diversify within region, diversify within investment, and also diversify within asset class, right? We're going to look at risk, how to look at risk, right, around different asset classes. Hopefully, we have time to do that. And also, last but not least, I think, which is my favorite, is we're going to model a $200 million portfolio fund. Hypothetically, we're looking at a hypothetical case if Liberia were to take the 200 million, I think 220 million, but we'll look at 200 million, right? Investment that they're talking about. If we were to take that 200 million and invest it in different regions, different asset classes, we're going to look at two scenarios. One, we're going to look at 15 years time span, and also we're going to look at 30 years span, meaning we put that money in, it is being managed either by a custodian or you can establish your own reporting company to manage that as well, in addition with the custodian, with no withdrawal being done to that, what that is going to do, how much are we going to have at the end of the 15 years, and also how much is going to be in that portfolio at the end of the 30 years, right? So this is what we're going to do today. Again, as I always said, bring your questions, but more importantly, bring perspective, because the perspective from which I'm looking at it is the perspective from which I do invest some of these funds, right? So you could be looking at it from someone who could be, who have some money. Like I said, we have some wealthy people in the portfolio as well. Some people that have like 50 million, 100 million on the side, they don't know what to do with it. They just give it to you to invest it. So you could be from that perspective as well. And some of the questions you could have will be able to help us share lights on this. All right. So again, without getting too bogged down into this discussion, this is until somebody join, I'm going to be doing this alone. So I don't want to be talking too much here. I'll be bogged down on one topic, right? So let's get into it, right? So the question is, what is a sovereign wealth fund? When you talk about sovereign wealth fund, we talk about it, and I think, please, if you have time, Google, go on Google, Chat GPT, it'll give you a breakdown what a sovereign wealth fund. But a sovereign wealth fund is a state-owned investment fund, that is created and managed by, a national government, right? Um, it's government-owned. It is a long-term investment that invests, as I said, in different asset classes. It looks at stocks, bonds, real estate, infrastructure, and even private company, right? So private company such as there are the bigger funds out there, such as the Nordic company sovereign wealth funds. They do invest in private company. So companies that are private, that are on the verge of going public, such as the uh, what do you call it, the Coinbase, or the um, what is the owner of ChatGPT and all those private companies that are out there on the verge of going public. They invest, because those are very risky. So, their investment strategy, you have to be very sophisticated and you have to have deep pockets to do that, right? So some funds do that, right? But typically on the broader horizon, they look at equities, right, which are stocks, bonds, government bonds, and most importantly, real estate. And some do invest in infrastructure, right? We also want to look at the stability and savings, right? It's actually done for several purposes. Some do it for stability. Some countries do it for savings, right? usually for stability. You do that to stabilize the country during economic downturn, right? So you basically saving in case there's an economic downturn, you can go into it and tap into it. Others are basically for long-term perspective, right? And again, as I said, they are usually diversified. Um, it's used to diversify your revenue source, in case there's a downturn or, a shortfall like we normally do within the Liberian budget, right? You're able to use some of that fund to shore up the shortfall within the budget, which we don't have. This is why every time there's a shortfall in our budget, we go out and go borrow to add on to it, or we go begging for grants. Like the EU just gave us 21 million to shore up, um, uh, as a budgetary support, right? So that's basically what sovereign wealth fund in a nutshell. But let's get into the meats and bounds of what it is specifically. As I said earlier, type of sovereign wealth funds, right? Specifically for stabilization. Uh, some are actually set up for stabilization. Some are used for saving and future generation, right? Which is, I believe, the one that Ty talked about was basically the purpose of the fund, right? For future generation, meaning we're just going to invest this. We're not going to touch it. This is going to be used for future purposes, right? Uh, some countries do have a developmental focus fund. As I said, they use the fund to carry out developmental initiatives. Some do it for pension reserve, right? They use it for as a way to shore up pension fund for the retirees who work in public sector, which is basically most of the ones that I've dealt with. And as I said, the other ones are basically strategic investment funds for various strategic reasons. It could be, interest rate hedge, and other reasons, right? So let's look at the the uh, the top five sovereign wealth invest funds out there, right? We have the Nordic, which is the well-known one that everybody talks about. Norway is at 1.7 trillion. So the fund is so big that 25% of the Norway budget it's comes from their sovereign wealth fund. They are invested basically into everything. Uh, you name it, from bonds, infrastructure, uh, you know, different asset classes, real estate, different asset classes across different regions from Europe, Asia, even North America, which is here to do a lot of investment here. The next two down that line are actually uh, from China, right? The China Investment Corporation and the China uh, Safe Investment Company, right? Those are all over $1 trillion. China is the China Investment Corporation is 1.3 trillion, and the Safe Investment Company, which is also a Chinese fund, is over $1 trillion, right? Next down that line is the Abu Dhabi Investment Authority, which also sits at 1.1 trillion, right? And then further down that line is the Kuwaiti Investment Authority, which is also exactly at $1 trillion fund, right? So with these funds, right, these are basically perfect example. The Saudi Arabia, I think I left that out there, is actually also on there. But let me tell you a quick story about that. So the Saudi fund, I think, is almost at 900 billion, so almost around the $1 trillion mark as well. And some of the things they do, and the reason why I wanted to talk about this, even though I left that out in the slide, a buddy of mine, a former classmate, he and I went to the same business school together, same program. We sat in some classes as well. His whole time in uh, business school was basically funded by uh, his country, meaning the government was funding it. And when he and I talked at the time, I wasn't aware about this, but he said they have a fund where if you want to leave to go outside of the country to study, the government pays for it, right? When he left, he went back to Saudi Arabia. Now he works as a senior analyst within the Saudi government, right? So again, those are some of the reasons why sovereign wealth funds are actually set up, uh, mean to advance either education or strategic investment or wherever the country feels fits within the model to establish the sovereign wealth fund, right? Now let's go to my next favorite thing on here is basically something that is very important to me, and this I will probably spend a little bit of time on this, and the reason why I want to spend a little bit of time on this is because we've often hear about concessions, concessions. So every time you hear me talking about concessions, the biggest discussion point that I usually talk about, uh, that is a pain point that I usually see with every concession that we've signed, are structure. Structure. When you hear structure, when people talk structure in contract or in legal term, it is, it's sometimes I know we often throw words around, like people throw strategies around. People say, oh, strategy. But what does that really mean when somebody says structure, right? Fund are structure in layers, right? They're done so purposely for protection, right? But also, yeah, for protection to hide, uh, you know, the owner of basically the fund, right? So you're looking at a very complex structure here, right? Let's take a deep dive into it. So you look at the government that is on the top, right? There's a capital allocation, right? Then there's a management team, right? The sovereign wealth fund management team. That management team picks the asset classes the fund will be invested in, right? Now this can be done in two folds, right? The management team along with the custodian, meaning the company that is holding the fund that's going to be deploying that capital, right, can team up to pick the strategy in terms of how the fund is actually invested, either in public equity, meaning stocks and ETFs, or fixed income, where I usually refer to this as the old people money because it's steady, it's fixed, the returns are fixed, they're steady over time. It's either you're getting it 6 months or you're getting it every year, right? They're fixed. That's why it's called fixed income, right? Those are bonds, if you want to another name for them. Then we have the alternative investment, real estate, private equity, infrastructure. These are very complex uh, um, asset classes, right? And then usually there is some level of cash reserve, right? Meaning it gives you a little bit of flexibility. Well, if you were to, in some cases, you want to tap into the fund, for whatever reason, you're not going to go, liquidate, your equity, your fixed income, your alternative investment. You will go to the cash. So in that, the returns are very minimum. Usually with cash reserve, because of that quantum of money that you're putting in, you probably get 2 to 3%, right? It's still a lot of money if you look at the size of the cash that is sitting in that investment, right? So once the structure or the investment team picks out the investment, right? Then there's also the return. Then we look at the returns, which we will get into later on through this, right? Um, but what you're looking at here is basically the structure of basically either a sovereign wealth fund, an endowment fund, right? Um, for big companies that do concessions, this is how they do structure. When I mean structure, meaning you will see the parent company will be on the top. Then under that parent company, they will establish what we call a subsidiary. The subsidiary will now go into the country of target to establish there to do business with the country of interest where they do investment. Now, the reason why I brought this up because sometimes, and I think if you have any government people watching this, this is very important. So in structure, if you are going into business with a subsidiary that is, registered in your country to do business, right? In this case, let's say if any of this fund were to go into Liberia to do business, you shouldn't just go into an agreement with the subsidiary, but also make the parent company, in this case, the government, right? Or the wealth, the management company that is where the capital lies, where the asset that holds the asset, right? A guarantor, to this agreement, right? So this is where we often, in every concession that we have signed, we have dropped the ball on it. And the reason why, as I said, I wanted to spend time on this because this is very important, right? Let me go a little bit deeper into this on a personal story. So I'm a portfolio manager. I I often say this most of the time, but this is what I do. I like to just tell people I'm a banker because I think it's easier to for them to understand, right? So as a portfolio manager, you have, uh, in my case, I have about 12 companies, right? 12 uh, relationship within my portfolio. They total about 1.5 billion, right? The biggest in the portfolio is a $900 million fund that I manage, right? And this is the reason why I'm wearing a hat. This is the reason why I'm bald, because that's the stretcher, one of the biggest uh, and the most complex portfolio within in my portfolio, right? And the reason why I wanted to talk about this because it will shed light on this. In the event we do end up going establishing a sovereign wealth fund, this is how you should look at it, right? So let me just walk you through this. Let me get this thing out. Um, if I can, just give me 1 second. Actually, let me leave it on. So maybe you guys will have a better understanding, right? So the fund, which is a $900 million fund, basically invests in three continents, right? They're in Asia, specifically in Australia, in Europe, specifically in Great Britain, right? And continental United States, right? Their strategies basically is real estate focused, specifically what we call industrial real estate, right? Industrial real estate, what is that? Meaning, if you see, let me put it in Liberian term. So, perfect example. You see, there's a huge population on the Ravensfield Highway, right? There's a huge number of people moving to that, a large number of people moving to that area, right? So, as a fund or somebody who is investing, basically you will look at industrial asset classes within that area. What does that mean? Meaning, with that number of people moving in that area, there's going to be a need for what we call grocery stores, right? There's going to be a need for uh, warehouses for whatever reason, warehouses for people who ship items in large quantity. There's going to be warehouses for distribution, right? So the fund goes out and it specifically look at the census data, and it looks at the population growth within a certain area, right? And it goes specifically in those areas and buys strategic industrial real estate, right? And then what it does, it leases those real estate to companies such as Amazon, such as the uh, UPS, such as the United States government, the United States Postal Service, right? And these companies, these lease uh, company use that as a warehouse, right? So the fund that I manage, one of their focus is basically industrial real estate, right? So they take capital, they invest in industrial real estate, right? Or sometimes they buy the property. It would need what we call tenant improvement. They'll probably put like, maybe 15, 20 million into it to improve it and put aside additional what we call tenant improvement concessions, right? To bring that property up to speed and then lease it out, right? Another asset class is basically what we call the data center that you guys are hearing about now, such as the Visa, the Facebook that you and I are on right now. All this data that they're collecting, they need warehouses. There are investment funds out there who invest in that. This is like literally building a power plant. Uh, I'm not, the fund that I manage doesn't invest in that as well, but a buddy of mine, a colleague of mine also deal in that space. Mine is data centers, uh, uh, office buildings, and also multifamilies, right? So that target, that's my target, right? So they do that, they invest that fund, they take capital, deploy in those assets, and basically look at different time horizon to yield returns on those investments, right? Now, let's be honest here. Not every investment goes as you plan, right? Uh, Sometimes you buy a property to take, they probably sit on it for a year or 18 months, until it goes up in value without even putting anybody into it, right? And they usually turn it around and sell it, right? So that's the reason why I wanted to spend time on this. Hopefully, I made enough sense for you to understand structure, how structure work, and why some of these investment company are structured the way they do, right? Um, so let's. I think we talked about this as well. Let's talk about the investment strategies that these funds use, right? And as I said earlier, funds are usually diversified across region, across sector, and across asset classes, right? Meaning, in this case, we're talking about equity, right? So let's say we had an investment, sovereign wealth fund that decided to invest solely in uh, equities, meaning stocks. There's also diversification within the stock market. There's large cap, small cap, and mid cap. Small cap meaning these are very small company on the upbring, right? They're very risky, right? So, but the returns are also equally large as well as with the returns. Then there's the mid cap, right? The mid cap, there's maybe 15 to 20 years company been in existence for quite a while, but they also have the upswing mobility to grow bigger. And then there's the large cap. Many of these are like your Amazon, your Facebook, your Google, Meta, and you know, Nvidia, right? These are large company within the S&P 500, right? So if you do decide to go with equities, meaning stocks, and you can diversify within that asset class, right? Or if you do decide to go with, bonds as well, you can do sovereign or corporate bond. Sovereign bond is basically that's equivalent to you going and buying bonds of the United States or Liberia. We do have T bonds. I mean, uh, right, treasury notes that they do sell as well, right? So you can do either or. Real estate, which I've spent a little bit of time on as well, is a vast asset class. As I said, there's multifamily, there's offices, there's data center. Data centers are the hot topic right now on the market, but you need a large amount of capital to invest in those, right? We also have life science, right? Lab, well, for better word, life spaces, meaning you can look at a building, buy it, and repurpose it to be a lab space, meaning this is a building that gets repurposed for drug development, right? It's also, this is a big asset class within the Virginia area, where I live in Massachusetts, within the 128 corridor, and also the other places, California. So those are the specific areas. So this is where a lot of what we call lab spaces take place. A lot of drug development in the East Coast, Massachusetts, specifically 128 route. Um, you got Virginia and also California, right? So there's that. There's also office spaces as well. Uh, Real estate. I'm not leaving out anything else. And there's also industrial. Industrial, basically, you're studying uh, where people are moving, where there's a population growth as well as income growth as well, and to see if there will be a need for an industrial space in that area. Um, and I forgot, yeah, hospitality. Hospitality, which is basically um, your hotels, motels, and all of those, right? One of my clients is basically uh, a guy who been doing this for 25 years. He builds the Marriotts, right? This is all he does. He build Marriotts, uh, sits on them for 3 years, and then sells them to one of these, what I call private companies, either like the Blackstone or BlackRock, takes that money, go and find another strategic area, go and then build. another and build another one. So that's basically his bread and butter. That's what he's been doing for a long time. So the way hospitality investment works, so every time, let me just spend a little bit of time on this, right? Whenever you see Marriott, they're not owned, they may not necessarily be owned by Marriott. It could be just a Marriott name on it. They're paying royalty fee to Marriott, right? It could be a private owned. Some people can come in there. Like I said, one of my uh, client, he builds it. He waits the way it get value. You wait till the occupancy goes to maybe from to 90% when it's being occupied a lot, because that's why they value. That's when you evaluate it, you get a lot of um, the higher price for the valuation for the property. He sells it, and then he takes that capital and goes somewhere else. The next on the line, as I said, this is alternative asset, right? I wrote an article about this, the private capital. Private capital are basically um, risky investments, money, meaning this is money that are given to private firm to lend. The private capital have less regulation compared to traditional bank, right? Because of that, the interest rate on those are very high, right? We've had failure within our area because they've lent to some subprime auto industry, and has triggered a lot of um, what do you call it, a failure within, I think, 3 or 4 or 5 companies, with 3 or 4 or 5 then with the JP Morgan being one of them. But so it's a very risky field. The other one is hedge funds. So hedge fund basically is high frequency trading, high frequency trading. I can't spend too much time on that because we don't have enough time. And then there's commodities and renewable. That's supposed to be renewable energy. And last but not least, infrastructure. Some of these funds also invest in some of the biggest infrastructure you see here. They do public-private partnerships. So let's say a city wanted to build like a road, they could team up with them, provide some of the capital, um, uh, and then, over a long time horizon to invest in our property, in our infrastructure project, right? So um, I'm not sure. I've been talking about this for the last 30 minutes. So let's get into the last session of this discussion. Hopefully, I'm not haven't bored you yet. So the whole point of this discussion was basically to not just look at sovereign wealth fund, but to also look at basically the possibility of modeling, which I had opportunity to do, to model a $200 million initial sovereign wealth fund over 15 years and also over 30 years, right? Now, the way I look at this is basically if I were the uh, the portfolio manager on this fund, how I would have invested it is basically how I presented this. So what you are seeing on here is basically how I would have, invested this fund. So 45% or $90 million would have gone to public, you know, private, should have been to equities, right? So stocks and bonds. I would have put another 20% or 40 million to fixed income, meaning stocks and bonds, right? I would have committed another 15% to private equity. These are startups company. I know that's risky, but this is a long-term horizon, so you have enough what I call runway to 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 play with, right? And another 15% in real asset in real estate, which is 30 million, and 5% liquidity. So I would have kept 5% in cash, which is 10 million, right? And so with that being the baseline for the structure, let's basically get into the fundamentals in terms of returns, right? So we are looking at basically assumption on a historical, and basically the way I model this is basically just looking at the market, historical market, nothing fancy, just the broad base, right? And as I said, the strategy would have been to invest in North America, right? US and Canada, right? As I said, 45%, 20%, 15, 15, and another 5%, right? On a $200 million investment. So let's see how much we will have if we did invest that over 15 years time and also 30 years time, right? So 15, this is the difference, right? So 15 years, we are looking at basically 579 million. So if we were to take 200 million and put it into that investment structure as we structured it, the 45, 30, and whatever we just talked about over 15 years, we will have 579 million over the time frame, right? Duration of that investment, right? Um, Now, let's on the 30-year mark, if we left that fund, that 200 million over 30 years, we will be looking at a 1.8 billion dollar bucket of fund returns, right? Uh, Over the period of 30 years, right? So you can see the difference that time horizon has over an investment. If you're looking at, you know, and again, listen, I don't think I am the best portfolio manager out there. I think there are even more savvier people out there than I am, that could take other factor into consideration. Or maybe some will probably say move everything into equities and just let it do what it's supposed to do, or maybe move 80% of it into equity, right? But again, as I said, I wanted to diversify across asset class and across uh, investment, right? So basically, the way I structured it, this would have been the return. $579 million over 15 years. And if we wait till 30 years, we will have a $1.8 billion in that portfolio. And that is basically from a conservative approach uh, horizon, right? So let's look at basically the risk management, right? Asset, I think we talked about this earlier. You have to look at asset diversification, right? Meaning you're not just investing in stocks. You want to look at uh, different asset classes, meaning you want to look at real estate, you want to look at bonds, uh, you want to look at alternative asset, right, which is private capital as well. And the reason why you want to diversify is, again, this is a no-brainer, but in case there's a downturn within because the stock market and the bond market have a converse relation, right? So whenever the stock markets are down, the bonds are up. Whenever the bonds are down, the stock market is up, right? So you want to hedge yourself, right? That regardless of whether we are in a downturn economy in the stock market, you're still steadily moving across. You're benefiting from the upswing in the stock market. If there's a downturn within the stock market, you're benefiting from the upswing within the bonds market, and vice versa within the real estate, right? Um, and then we also look at geographical concentration, which I talked about earlier, right? So the fund that I manage, right, it invests across different region. As I said, we're in Australia, in Europe, and every corner of the United States. So if you look at the United States, I think we have some our neighbors in the north. I don't want to mention their name, right? We have some their police retirement in our portfolio as well, right? So you are looking at the United States, where California, Tennessee, New York, almost everywhere in the East Coast, Maryland, New Jersey, um, even what do you call it? Savannah, is that, I think what they call it, Savannah, Georgia, where the port city is, right? We have some asset classes there as well. So you have to look at it not just regionally, but not just on a geographical, regional areas as well. But you also look at basically regional diversification, right? The reason why you do that is because if you're into real estate, as most people are, right? You know, the Sun Belt state are basically uh, you get a lot for your bucks there, but the return on capital on that is not very high. Whereas in the Northeast, you put a lot of money in, but the return also is very high as well. So you diversify in different asset classes, right? Also, you're looking at office space, um, uh, life sciences, data center, as I mentioned earlier. Uh, so you look at geographical concentration and also diversification as well. And basically, I know this is something people don't talk about. ESG for those of you who care about the planet, governance structure. There's if you're investing, you have to conform to that. This is one of the big thing that is out there now. Um, when I first joined, I was actually tasked, and this is why I knew a little bit about ESG and climate change, to help basically when every company was transitioning to climate change, right? We had to help some of our clients actually transition to that as well. But this is a standard requirement within the investment world, right? I know there's a peel back on that now. There's a pushback on that now because of the current administration we have in office. But within the core of the investment portfolio, you still have to conform to that as well, right? Um, and also the other thing you have to consider is also rebalancing. Rebalancing, regular rebalancing, meaning you have discussion with your clients. You take some of their concern into consideration because people panic when things are not going well. People panic, right? Or then when they hear things out there, they panic. They will call to you and say, "Oh, such and such and such is happening. What do you think about it?" Right? In cases like that, you sit with them and really have a good discussion with them in terms of, you know, you look at age, right? But you also look at a time horizon. Like I said, these are, um, you know, some are some of the biggest churches. These are some of the biggest universities. Some of the state pension funds are in there as well. So they want to make sure you're not messing around and playing with people's lives, right? So they will have a discussion with you as well. And again, a part of that is also you stress test, right? You do scenario analysis. What would happen? This is something we used to do every 3 months, right? What would happen if the Fed raise interest rate by 1%? I mean, not 1%, but quarter of a basis point, 25 basis point, right? What is the impact on that? What will happen if there's a a shift, a downshift in the economy? Maybe GDP was expected to grow by 3%, but what happened if it grows 2.5%? What is the impact on the investment, right? We also look at policies as well within the government, right? What happens if certain policies are passed that impact um, the life science, which actually did happen. There was, I believe, in 2023 or 22, there was funding being cut to universities, right? And I think you guys heard research, which I believe it was this government, right? And that impacted the life science spaces because most of these big universities you see they actually do have research labs going that test for some of the drugs discovery that you have in this country that we're very fortunate to have, right? So you look at that as well. For some of those policies, you look at what would happen if such policy became law. And these were, or some of these policy took effect. What would be the impact on the economy as well? So you're constantly looking at scenarios like that, right? In addition to that, you have to look at um, some of the asset classes you invest in. What happened? They don't perform well. What do you do? If you're if you are managing, let's say, 150 million of the state of New York um, retirement fund, right? And they give it to you, and you go to invest it, and all of a sudden, that asset class you pour that money in is not performing anymore. what do? Right? Perfect example. When I first took over, there was a what I call covenant breach. You guys often hear me talk about covenant breaches here, right? But covenant breaches are usually things within a contract, meaning if you do X, Y, and Z, I will do A, B, C, D, right? Um, at all time of that contract, you need to do X, Y, and Z, and I will do A, B, C, and D. What happened if you do only X, Y, you don't do Z, right? That means you've breached the contract. And within that contract, right, or agreement or concession, you want to call it, we will also define the terms. If you do only X, Y, and you didn't do Z, that you breach that contract, that means you have to do, right, E, F, G, right, to kill that covenant, meaning we would define what you need to do to kill that covenant. So perfect example. I One of the, as I said, the biggest fund, there was a, within that fund, there was a breach within the fund, right? Where you're supposed to have a specific what we call debt service coverage at all time at 1.5, meaning your cash flow to service your debt, to cover your debt, whether you're hedging that portfolio, including the hedge amount, supposed to be at 1.5 times your debt, right? When I took over, that cash flow was at 1.08, right? Way below what it needs to be, right? Way below what it needed to be, right? And within that fund, this was a $300 million, right? And the beauty of dealing with savvy investors, right, who understand the agreement, that the same agreement that you're dealing with, if they make a mistake, that when there's a breach, they will come to you with the table, say, we are going to do A, B, C, and D. Now it's up to you to say whether you're going to accept that or you're going to go back to the contract and say, no, I want you to add these other steps to that as well. And then you guys negotiate from there, right? This is why negotiation is very key, right? So when that happened, we went back to before we even reached out to them, they came back and said, listen, we're going to pay down the line for we're going to pay down that investment, and take a loss on it. We're going to what we call hedge $75 million, meaning, so uh, maybe we can do that on another show. But hedge is basically meaning there's a, for interest rate, right? For interest rate for this investment out there, we're going to hedge all the other debt out there by another 75 million, right? Meaning they'll put another 75 million in. In addition to that, they will pay down the loan, right, that we give them to invest by 45 million. And then they will hedge another 75 million, right? So they came back to that. They came back to us with that, and they said, okay, what are you guys going to do? So with that, even with that pay down of a 45 million, what they're going to pay down 45 million, we still weren't at what we needed to be from the debt coverage service standpoint, right? So what we had to do, we do what we call a step up basis. So you were at 1.5, but you're now at 1.01, right? So we do step up basis, mean every quarter, every 3 months, we want to see you go from 1.08 to 1.15. The next quarter, we want you to see you go. We want to see you go from 1.15 to 1.2. You will do that every 3 months until you get to where what you used to be, which is a 1.5. That span was supposed to be over 18 months, right? And we did that. So the pay down 45 million, hedge another 75 million, right? Derivatives, right? And then that's how they killed that covenant, right? Because they breached that covenant, they did everything within the covenant kill provision to kill that covenant, meaning we went back to the loan agreement and they killed that covenant, and we went on from there, right? So again, this is why when I talk about concession, I always said, please, whatever contract this government of Liberia signed, please do make sure that you have um, you have concessions in that. I mean, covenant kills in the covenants are very important, And we had another show on here where a buddy of mine were arguing, or you know, things that weren't in the health MOU. I say if it's not in there, you can't argue that. You cannot mandate somebody to do something that is not within your contract, right? But anyway, those are some of the things you need to look at for fund. These are some of the most sophisticated people you would ever deal with. Some of these people are way smarter than you. You just happen to be in position of managing their funds as well, right? And they don't have time to do it, so you're doing it for them. But they're way a lot more smarter than you. Sometimes, you by talking to them, there's a whole lot that you learn from them, right? And I think there's an opportunity here. If we can muster the courage to you know take some austerity measure, put that 200 million aside, and really do something here. As to his credit, Ty proposed. I didn't read his bill, but I don't know what it contains within there. But to do something, to put that kind of money aside to really start something, that equivalent of a sovereign wealth fund. I think it will go a long way. 15 years is not much of a horizon. By the time you get to 15 years, right, you will literally almost have the equivalent of your own budget that you collect every year in a pool of money sitting aside. You go another 30 years, you will have over a billion, which I doubt. Well, I don't want to doubt that. Hopefully by then we'll be able to have a budget that is over a billion or almost $2 billion, right? So you will have equally two budgets. I mean, two pool of funds to tap into, and I'll do anything you want to do with it. Not to go depleted, but basically the return that it gets annually to take away from it, right? So let's go on to the next step here. I think I'm talking too much. So what are the expected outcome? When I modeled this portfolio, as I said, was the target was between 6 to 8% annually. Now, if you follow the stock market historically, it does about, I believe, 10%, right? But because there are other asset class such as real estate, such as the bonds, so it kind of weighed down the overall return scenario. So that's the reason why I stuck with between 6 to 8%, right? You also have to look at inflation, right? What this can do as well, it gives you protection against inflation, right? Stable income generation, long-term capital appreciation, if you have it, basically by reinvesting the dividends, the returns, the capital appreciate, right? And what it helps you do as well is to be resilient across economic cycle, right? Meaning you know how the economy works, right? There's ups and down, there's ups and down, there's ups and down. But with that kind of fund invested across different asset classes, different sector, different region, what it does, it gives you that uh, what I call a springboard that you can fall back on but bounce back on, right? Without remaining down, right? It gives you a good safety net, if you want to call it that, right? And one of the important things as well is adopt as clear governance and mandate, right? Meaning, and the reason why I put this out there because I know the way we do things as Liberians, right? That fund get put aside. We say, okay, we're going to invest for 15 years or 20, 30 years, right? Some administration will come and say, we have a budget shortfall, so we need to break that rule and go, uh, tap into that funds as well, right? And so you have to have a clear governance structure that is committed to the duration, the time frame, and have a very outline in terms of if once you get to that targeted return, which is be it 15 years or 30 years, how you're going to if you're going to draw down from that fund, how you're going to do it. I mean, my recommendation would be basically to just take a percentage every year of the returns, not the entirety of it, but take a percentage of it and, do a targeted support, meaning, let's say if the fund's returning 8% every year, take 4% of that, put it towards education. The next year, take another 4%, put it towards infrastructure, take another 4% the next year, and do a targeted investment like that. So that way you're not just going in and just taking the entirety of the fund and doing something else different with it, right? Again, as I said, follow a very disciplined asset allocation, meaning, you know, as I say, economy change, but diversify across how you allocate your assets as well, right? Maintain a long-term investment horizon. I said 15 years. You could do 30 years. You can even do up to 50 years, right? And you say, you know what, I want to compete with the likes of the Nordic country to be up to 1 billion. All right, good luck, but I think it's doable. And then gradually increase alternative exposure um, in other areas. Um, so um, my conclusion here is, investment funds such as for you and I savings are very powerful tool for national wealth management, right? Um, the top, you know, sovereign wealth fund demonstrate discipline, diversification. If you go back to either the Norway or the China investment, or the Saudi, or even the Kuwaiti, right? These are strategic fund that they've invested not just in their country, but they're everywhere in North America and Europe as well. That mirror a global best practices, right? So these people were able to take their funds and invest in that, right? Um, you know, the same thing goes for state. Some of the states that you live in, I said this earlier, and I'll continue to say it. Some of the state that you live in have massive endowment funds that they are investing in other uh, through other subsidiary entities, right? Um, so there's always the need to make more, right? And then, as I always said, take a long-term success. Long-term success depends on a governance structure, patience, and diversification. You have to be patient. You have to be patient, and you have to think long-term. Whether this was a sovereign wealth fund or your vision as a person in terms of where you want to be when you retire on your personal investment journey, you have to think long-term. Don't allow, oh, well, there's a prospect of a recession, so I'm going to go withdraw from my. No, you have to think a long term, meaning the diversification strategy you have should incorporate that into your uh, strategy in terms of your long term perspective, your long term goal as well. So I think I've said enough on this, but hopefully you guys were able to learn a little bit from this as well. As I said, this was a topic we wanted to talk about since this conversation came about a sovereign wealth fund, and I believe some of you probably Google it or Chat GPT or Grok, use your Grok AI to get a little bit of understanding. But um, you know being somebody who plays in this field, there's a lot of complexity that you will not find on Google or you will not find on ChatGPT. But regardless of that, I think and I hope, and again, when you're dealing with Liberia, you got to put hope in your strategy, even though it's not really a strategy, right? Because we never follow through on things, right? I hope that we can really follow through, and even if we don't do the entire 200 million, put aside 150 million, right? Just how we have the reserve at the New York Fed, right? We can do the same thing too with the sovereign wealth fund, and build on from there, and do something very meaningful uh, for the future generation. But hopefully we will do another session on specifically on endowment, and another one on hedge funds. I know these are very touchy, very complex topics, but I I'm glad that you are able to stick around to maybe hopefully you're able to learn a thing or two about uh, what we talked about here, what I talked about here, structure, um, different asset classes, how some of these big firms, sovereign wealth fund actually do their investments. And in the case that we do have the opportunity to start one, you can say, oh, you know what, I know this kid who talked about that, let's go back to his video. But that's all I had for you. And as I said, I hope you were able to learn something or two. If not, check back uh, on one of our shows. Maybe you'll be able to learn something the next time. But again, thank you for taking your Saturday to stick with me um, for the last hour or so, and I will see you on the next topic. Again, thank you. I don't see a lot of comments here, so I'm just gonna uh, I'm just going. Actually, there are a few comments here, so let me just run through these quickly, and then I'll wrap up. Uh, Voila. Uh, what was this? Um, uh, this presentation is a great topic and an excellent presentation. And then this is Maurice Ja. Maurice Ja. Hopefully, I say your name correctly. So I'm watching from CM. Liberia and their politics. Halai, halai, halai. He said, I'm watching from my CMC in point four, CMC corner in point four junction, Morovia in Liberia. Uh, uh, Morris, I see what you guys are doing is CMC. Continue to do that. Um, and this person said, Gilbert, can you give us your contact info? Um, yes, well, yeah. Hopefully, you're still on here. Um, Let me see if I can put it on here. So I'm not sure what specifically the conversation will be about, but I will drop my personal cell here. Um, I think it's public information is out there, so if you can't find it, then, but I'll just drop it in the chat here. Uh, Voila. Okay, and then there's David William. He said, um, he said, I'm watching from Colorado. Hey David, how's the weather over there? I know you guys are in the mountains. Um, okay, so this person is in the financial planning. Okay. Um, all right, so that's all we have for comments. Again, thank you. I really appreciate you taking the time to spend some time here with us. As we haven't been consistent on specifically on the marketplace, but we going forward, we want to be consistent. So the next we will maybe do a deep dive into it. I don't think I really, as I said, this was an overview, or maybe we'll talk about the endowment, and I will go in depth in terms of some of the ways some of these endowment actually works. Whether this is what I call a state endowment fund, such as the Royal Police of Canada Endowment Fund, right, where they invest for the Royal Police retirement, or this is New York. Your New York, you have $150 million to invest, or your Tennessee or Philadelphia, Pennsylvania. I mean, um, you have pension fund, or you had the Baptist church. You want to put your money somewhere else for your congregation. But again, to really go deep dive into some of these funds and I mean endowments, and really, or you're one of the biggest universities, some of the big universities here, right? I know a university that has 4 million. They just 4 million, right? They have it in there, just invested. You know, um, you know, it's something the University of Liberia could use as well. With the way how dilapidated those schools been. You could put money aside for future, upkeep and maintenance purposes. But anyway, I think I've said too much. I will wrap up here from now, and I will talk to you guys later. Again, thank you for watching. Uh, and as we always say here, whether you agree with me or uh, you you don't, whether you think we need a sovereign wealth fund or we don't, or you think the government can do it without a sovereign wealth fund. Um, there's a common denominator between us is that we're all Liberians, and we'll always be that. We just want the better for the country. But again, thank you. I think I'm talking too much, and I will talk to you later.
We are Liberia. Liberia is our home. Liberia people. Liberia.